In this video, I am going to discuss about integrated systems. An integrated accounting system is where the same set of accounting records are used for both management and financial accounting. In management accounting, financial informations are used to make decisions. And in financial accounting, financial information are used to prepare financial reports for external requirements. By having a single set of accounting records, an organization can ensure consistency, accuracy, and transparency in its financial reporting and management. Now let's discuss about why integrated systems exist. Because otherwise companies have to maintain two separate same set of financial records for financial accounting and management accounting, which is a waste of time and resources. If companies have to maintain two separate same set of financial records, it will be a duplication, which means now the company has to do the same work twice, which is a waste. In such a system, the accounting records are designed to capture all relevant financial information, including revenue, expenses, assets, liabilities, and equity, in a structured and standardized format. The records are then used to generate financial statements, such as the balance sheet, income statement, and cash flow statement, as well as other management reports, such as standard costing and variance analysis. In simpler terms, this means that now the company can use same set of financial records for both management accounting and financial accounting without having to maintain two separate financial records. Now let's do this example. Wages paid to employees 50,000. Let's record this transaction. So we have to credit the cash account by $50,000 and we have to debit the wages account by $50,000. So this is the initial record of this transaction. Now they have given us the two components under the wages. $30,000 out of $50,000 for the wages are for the production employees. So this is a direct labor cost. And $20,000 is for the supervisors. This is an indirect labor cost. Remember, supervisors, maintenance staff are indirect labor cost to the company because they are not directly involving in the production process. Only the production employees will be involved in the production process directly. Now what we have to do is we have to separate the wages amount into two separate accounts. This is because now the company is using an integrated system. This is where the financial accounting and the management accounting are done in the same set of financial records. As now you can see, the initial record of this transaction will be done by the financial accountants. But management accountants of the company want to know what is the direct labor cost amount and what is the indirect labor cost amount separately, because these information are really important for the management accountants. Now let's record the direct labor cost and the indirect labor cost separately using the same set of financial records. First, let's move this $30,000 out of this wages account into the direct labor account. Now let's move the $20,000 to the production overheads, because under the production overheads, indirect labor cost will be considered. So instead of having a separate account for the indirect labor cost, we include the indirect labor cost under the production overheads account. Now the management accountants can easily identify what is the direct labor cost and what is the production overheads separately. This is why the integrated systems are really important. So finally we can include the costs under cost of sales account. So the direct labor cost is equal to $30,000 and the production overhead cost is $20,000. As now you can see, under cost of sales, we can easily identify direct labor and production overheads separately. Now let's do this example. In this example, they have also included the previous example, which is the wages. So first, let's do the wages transaction. So we credit the cash account by $50,000. This will go to wages account, and the wages account will be debited by $50,000. And then we move the wages into direct labor and production overhead. Now let's record the first transaction. 10th of March 20x1, purchase of raw materials $1,000. So we credit the cash account by $1,000 and we debit the raw materials account. Then let's do the second transaction. 18th of March 20x1, electricity cost $4,000. So we credit the cash account by $4,000 and we debit the electricity cost account. Now let's move this electricity cost to the production overhead cost. This is for the ease of management accountants. Thirty-first of March 20x1, sales revenue 75,000. So we debit the cash account by $75,000 and we credit the sales account by $75,000. Now let's include all the cost of sales under the cost of sales account. So first, direct material cost. Then the direct labor. We do not have to include the electricity cost separately because we move the electricity cost to the production overhead. So let's find out the balance of the production overhead cost account. So finally we can calculate the cost of sales, which is the balance of this account. So this is the balance of the cost of sales account. Now let's discuss about the integrated systems with variances. Statement of profit and loss account is prepared using the standard costs and selling price per unit. This is important. Statement of profit and loss account is not prepared by using the actual amounts. It is prepared by the standard costs and selling price per unit. At the end of the year, actual amounts and the budgeted amounts will be compared and the variances will be calculated. Then using these variances, the budgeted amounts or the standard amounts will be adjusted so that the actual profit can be calculated. Whereas the T accounts are prepared using actual revenues and costs as the transactions happen. This will lead to variances between the standard and actual amounts. We discussed about how to calculate the variances in greater detail in early videos. Now let's look at the general steps to follow when adjusting for the variances in an integrated system. First of all, record all the transactions using double entry method. Then identify direct and indirect production costs separately and record all the indirect costs in the production overhead account. In early examples, we did this step. Then prepare the cost of sales account, which includes the direct material, direct labor, and production overheads. Using the standard costs and revenues, prepare the statement of profit and loss account to calculate the standard gross profit if it is not calculated already. Now you know the standard costs and revenues will be used to prepare the statement of profit and loss account. Then calculate variances if there are any. If there is a production overhead variance, adjust the production overhead account and P&L account. If there are any variances related to direct costs, adjust the cost of sales account and the P&L. If the variance is favorable, debit the production overhead account or the cost of sales account and credit the P&L. If the variance is adverse, credit the production overhead cost or the cost of sales account and debit the P&L. Now let's do this example so you can understand the steps we discussed earlier. They have given us the budgeted and the actual amounts. Budgeted units 2000 units, OAR is $1.5 per unit. OAR is the overhead absorption rate. Budgeted selling price per unit is $30. Budgeted absorption cost per unit is $6. Actual units 1900. And 18th of March 2000 electricity cost is $4,000. Always remember that P&L account is prepared using the standard costs and revenues. All the other T accounts will be prepared using the actual transactions. So first of all, let's record the electricity cost. So we credit the cash account by 4,000 and we debit the electricity cost account. And we move this electricity cost into the production overhead cost account. So this is the actual amount for the electricity cost. Now let's calculate and see if there is a variance for the production overhead. So the production overhead variance is equal to actual units multiplied by OAR minus actual cost. So the actual units is equal to 1900 multiplied by budgeted OAR, which is $1.5 per unit, minus actual cost, which is $4,000. This is equal to minus $1,150, which means adverse $1,150. Since this is an adverse variance, let's credit the production overhead cost account by 1150 because this is an under absorption. And this goes to the P&L account. Then we debit the P&L account. This is how we adjust accounts for the variances in an integrated system. If the variance is favorable, debit the production overhead cost or the cost of sales account and then credit the P&L account. If the variance is adverse, credit the production overhead account or the cost of sales account and debit the P&L account. Thank you for watching. See you in the next video.